Mortgage rates today just gave us some unexpected good news right before the holidays. If you've been watching the housing market and waiting for the right time to lock in financing, this week's drop could be the signal you've been looking for. But here's what most investors are missing about what this really means for DSCR loans and creative financing opportunities heading into 2025. Major economic events. This week brought us three major pieces of economic news that directly impacted mortgage rates and real estate investing. Let's start with the most surprising development. Consumer confidence just hit its lowest level since August. The Conference Board's report showed the expectations index dropping below 80, which historically signals recession territory. Now, you might think that's bad news for housing, but here's the twist. Weaker consumer sentiment actually increased expectations for potential Fed rate cuts in 2025. And that's exactly what helped push rates lower. But that wasn't the only story moving markets. On Wednesday, we got the PCE inflation data. That's the Fed's preferred inflation gauge, and it came in at 2.8% year over year, slightly above the 2.6% forecast. At first glance, that sounds like it should push rates higher, right? But here's what savvy investors noticed. The monthly reading actually showed moderation, giving markets real hope that the Fed's restrictive policy is finally working. This means the Fed might have more flexibility to cut rates in early 2025 than previously expected. The third piece of the puzzle was the Thanksgiving week bond rally. With light holiday trading volumes, we saw the 10-year Treasury yield drop from 4.32% to 4.02%. Mortgage rates follow Treasury yields closely, and this rally provided the momentum for the rate improvement we're seeing. For real estate investors, this creates a unique window of opportunity, not just for conventional financing, but especially for DSCR loans and creative financing strategies. Rates recap. 30-year fixed mortgage rate started at 6.32%. Ended at 6.22%. DSCR loans, which typically run 0.50% to 1.00% higher than conventional rates, moved from approximately 6.82% down to 6.72% this week. That 10 basis point improvement directly benefits investor cash flow. On a $500,000 investment property, that's $30 to $40 in monthly savings going straight to your bottom line. Professional analysis. Here's my professional take. If you're shopping for investment property financing or considering a refinance, this rate environment presents a legitimate locking opportunity. We're at multi-month lows during a holiday week with thin trading. The lock versus float decision comes down to this. Would you rather secure today's rates or gamble that rates might drop another 10 to 20 basis points while risking they could jump back up? In my experience, the smart money locks in the gains rather than chasing the last few basis points. For those using creative financing strategies, this rate environment also makes seller financing and subject to deals more attractive. When conventional rates are in the low 6% range, you have more negotiating power with sellers sitting on 3 to 4% mortgages from 2020 to 2021. The rate arbitrage opportunity is still significant enough to structure deals that work for both parties. Positive outlook. Lower rates mean better cash flow, stronger rental property performance, and more deals penciling out in 2025. That's the real opportunity for real estate investors right now.
Thanks for watching. If you found this video helpful, give it a like and subscribe for more expert insights on real estate investing. If you are ready to take the next step or have questions, call or text me at 718-300-3503. I'm here to help you understand the market, find smart loan options, and turn today's challenges into tomorrow's cash flow.
If you want to learn how to use financing to grow your portfolio, check out my DSCR loan tips and tricks playlist. Inside, you'll find powerful strategies, lender insights, and real-world tips to help you close more deals and maximize your cash flow.